Welcome to Pro Webcast News, where we bring you daily industry updates. Today is Thursday, May 13th, and you're watching the Afternoon Update with Paul Wilson. Today's news is sponsored by American Retirement Systems, providing competitive solutions for agents and advisors. For more information, please visit AmericanRetirementSystems.com. Now for today's headlines. Foreclosure activity fell in April as lenders continued to repossess homes at a record pace but started fewer new actions against homeowners, providing hope for a plateau in loan failures, according to RealtyTrack. The real estate data company said no significant improvement is expected to take place this year, as mortgage modifications and high unemployment are only putting off the inevitable for most struggling borrowers. However, April saw foreclosure filings, including notice of default, scheduled auction, and bank repossession, declined by 9% from March and by 2% year over year. Meanwhile, lenders filed notices on 103,762 properties for the month, down 12% for the month and 27% from 1 year earlier. According to Rick Sharga, Senior Vice President at RealtyTrack, quote, "What we're really seeing here is the effect of lenders slowing down the initial notices of default while they are processing what's already in the pipeline. The housing market is still in critical condition, but stable," unquote. In insurance news, a recent survey of 80 insurer CIO and senior-level executives found that the industry is set to move forward cautiously. The survey, conducted by Novarica's Insurance Technology Research Council, found that as insurers near the midpoint of the year, budgets are holding steady with slight increases by many, as policy administration projects are instituted across all lines of business. Late last year, large property casualty insurers predicted that budgets would remain level or increase slightly, but respondents in the most recent poll leaned slightly toward budget increases. Meanwhile, mid-size insurers have become slightly more conservative than projected. Overall, fewer than 25% of insurers in any category are reporting budget cuts for the year, compared with last year. The survey also found that top industry business drivers continue to support growth strategies and increase operational effectiveness, along with reducing organizational expenses. In other insurance news, the use of credit scores in personal lines of insurance deserves a closer look, according to testimony before Congress this week by the National Association of Insurance Commissioners, or NAMIC. Speaking before the House Subcommittee on Financial Institutions and Consumer Credit, Illinois Insurance Director Michael McRaith emphasized the importance of clarity and comprehension when insurers use consumers' credit scores in determining eligibility and rates. He added that while most states have taken legislative or regulatory steps regarding the use of credit scores, regulators are still seeking more insight into the variety and importance of factors compromising credit-based insurance scores. Quote, "To better protect consumers, regulators are conducting a multi-state data call to collect how rates are developed, the variables involved in determining an insurance score, and the weight assigned to each variable. The results of a broader multi-state survey will be compiled, evaluated, and published to inform policymakers about actual consumer impacts," unquote. The call will be issued within 60 days and completed, aggregated, and reported by the end of the year, the NAMIC said. I'm Paul Wilson, and thanks for watching Pro Webcast News. For more in-depth news and features, visit producersweb.com.